Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. I want to thank everybody for joining us this great Saturday. Hopefully everybody is having a great weekend. My name is Robert Kuhn. I am the host of Destination Retirement. That is the radio show you're listening to. I'm also the president and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm. And yes, we are a fiduciary. The job of an advisor is to make sure that we're bringing you strategies that can deliver in down markets. That's something that we take to heart. If you've listened to the show, you know that we believe in financial planning. We believe in income maximization. We believe in tax reduction. But we also believe in having strategies inside of a portfolio that can deliver in down markets. If that is something that piques an interest for you, let's have a conversation. You can reach out to our assistant page and schedule that time to get on our calendar, 630-492-1912, 630-492-1912. We are located in Naperville, so obviously just outside of the Chicago area. If you are listening to the show outside of the Chicago area, we do run the show in multiple markets. So I want to make sure that you understand that we continue to increase we try to increase the footprint of the radio show because we are all about education. That's something that we take very seriously. We are very passionate about. So if you can hear my voice, you can work with us. So just give Paige a call, 630-492-1912. Many of you know that we do dinners. The dinners are unique. The dinners are different. The dinners are educational. We've had phenomenal response from the dinners. We do them really predominantly in the Chicago area. So we know the food is a big driver. It's so funny. I always make a joke about that when we have the dinners, right? Everybody, you get a great meal. No matter what, you're going to get a good meal. Usually we do it at Morton's, and so we understand that. We understand that the food, the steak, the environment, to come out and have a complimentary dinner is obviously a big draw, but everybody walks away with a nugget or two that they didn't have before the dinner. And so much of Wall Street, so much of financial advice, so much of what you're going to hear on the radio is not what I feel is going to compound your money. And everything we talk about, our portfolio construction, the education topics that we bring to the table, it's all about compounding your money. Wall Street has gotten away from, advisors specifically have gotten away from talking about performance. I mean, isn't that the job of an advisor, is to grow your money? I don't think the job of an advisor is to handhold you when the markets are down 20 to 30% and you're down 20 to 30%. And then, the advisor is simply saying, just buy and hold, wait, it'll come back. I mean, nobody debates whether the markets long-term go up. That's not a topic for discussion. That's a historical fact. We all know that the markets are going to go up over time. What I try to stress to individuals, and you know what, given where the market is today, we're going to get pretty aggressive about stressing this because we want to help individuals not lose money, period. That is the goal of our firm. And when the markets are down and an advisor tells you that don't worry about it, ultimately it's going to come back, my question to you for that advisor is, well, I can do that on my own. Point to a specific portion of our portfolio that ultimately is going to deliver positive returns in negative markets to a point. Everybody knows, especially if you've listened to the radio show, that we do a lot of structured notes. I call them income bank notes. it's a strategy that is not new. It is a huge, huge market. Most advisors just don't do it. They don't do it because it's very labor intensive. You used to, in many instances, you used to have a large net worth to even have access to the banknotes. Today, it's $1,000. And when I can look at a client and say, listen, this note in particular will pay you 12% a year, 1% a month, as long as the indexes that the note is tracking are not down 30%, that's appealing. I know it's appealing because everybody who calls in asks about the notes. And that, to me, is something that I'm very, very proud of, because most people will tell you, don't talk about a specific product on the radio. Don't talk about a specific strategy. It's too in-depth. You're getting into the weeds. I don't care about that. To me, I mean, that's not the goal of this radio show. The goal of the radio show is to give you nuggets that you can use to not lose money. Now, there's a lot to the banknotes, albeit they're very simple, right? I mean, they are very, very simple. But yes, you need to know exactly what they are. We have to go over the risks. We have to go over, the pros. We have to go over the cons. We have to go over your situation. We have to go over, does it make sense for you? So when I give topics on the radio, when I talk about specific products, it doesn't mean that it's 100% slam dunk for you. Please don't take it that way. But I can promise you that there are so many people that if I can tell them that this bucket of money will make 12%, 11%, 13%, whatever the note price is at, as long as the indexes are not down 30%, that's a big deal. That is a huge, huge deal. And advisors, they're losing business to us because they're not educating clients on what is out there to generate positive returns in negative markets. If you don't have an advisor that is bringing you those types of strategies, having those types of conversations with you, educating with you on what they are, what they're not, those types of strategies, then you know what? You really owe it to yourself, especially in this market, at these valuations, to reach out, 630-492-1912. So yes, we are selling. We are selling hard strategies to give you the not lose money. That's the only thing we're selling is knowledge. And it's something that we take to heart. It's something that has done well for us, for our firm, for our clients, and we're not going to change it. So 630-492-1912. Tax reduction, tax reduction, tax reduction. Again, the most overlooked area of financial planning. Even people who don't need tax reduction want tax reduction. I get it. And it's something that, again, if you're working with a big bank, if you're working with a big brokerage firm, I promise you that you do not have proactive tax reduction strategies. As proactive as you're going to get, if you're going to match gains with losses, tax loss harvesting, that's not, well, I can't say it's not tax planning because it is. It's just not robust in any way, shape, or form. What we're talking about when it comes to tax reduction is strategies that can greatly reduce your taxable income. If you're a high wage earner, if you sold a business, if you sold property, if your stock options that you're exercising are increasing your taxable income, we need to talk about tax strategies. If you're doing a Roth conversion and you want to mitigate that additional income tax from the conversion, if you're taking RMDs and you're getting taxed on them and you're not happy with that, let's talk about strategies that can greatly, greatly reduce your taxable income. Strategies last year that almost $90,000 per $100,000 invested reduced your taxable income, active or passive, capital gains, etc. Now, I want to preface this. I'm not a tax advisor. So any decision that you make, it's always a best practice to reach out to your tax advisor. That being said, in the energy space, there are tax strategies, tax benefits that have been around for decades and decades and decades. And yes, if you invested $100,000 in a strategy that we utilized last year, you reduced your taxable income by almost $90,000. $80,000. And I love tax strategies. I don't think you make decisions simply based upon tax strategies. That's my opinion, my belief that tax strategies are great, but I also want a return on my investment as well. And so we target distributions in the 10 to 15 to 20% range on an annual basis in that strategy. And so, yes, you have great tax benefits, but there are also what I would consider to be very good targeted distributions that, let's just say, double digits. That's what we strive to do in that strategy. So I encourage you, if you're working with a bank or a large brokerage firm, you do not have access to proactive tax strategies. You don't need to work with us for 100% of your money. If you just want to work with us for your tax strategies and it's only 10%, 15%, 20% of your portfolio, that is perfectly fine with us. Let's have that conversation. If we can reduce your taxable income anywhere from $80,000 to $90,000 per every $100,000 you invest and have targeted distributions in the double-digit range, it's a very, very interesting strategy. Certainly here in the Midwest, almost nobody is bringing you those tax advantage strategies in the energy space. So we want to have that conversation, especially you've got, the rest of October, you have November, and then possibly December to affect your tax bill for calendar year 2024. So if you've heard me talk about it and you haven't reached out, now's the time to do it. Let's have a conversation about it. We've got, generally when you talk about energy investments, it's new. It's just new. It's a niche, and it's a niche of a niche as far as what we're bringing to the table. But that being said, it is, again, relatively simplistic. But yes, we have to go over everything about the option, that what we believe is a strength, what we believe is a risk. I mean, these are things that I should think would just go without saying, but you know what? I guess I just need to keep saying that. Every investment has a pro, every investment has a con, and or a perceived con. And it's like, you look at the annuity space, right? And you look at, what makes people sleep at night, this lifetime income. Listen, if you have 7 years, in my opinion, let's just call it 5 to 10 years where you don't need to touch that money, then we can talk about a lifetime income strategy. I get it. There is some merit there. But if you're going to take income within 5 years, I believe that those strategies are just not beneficial to you. I know they make you sleep at night because you have guaranteed lifetime income. I get that. But again, the guarantee only comes from when your account goes to zero. And then the insurance company is going to start to take money out of their own account and pay you. So again, if you own an annuity, if you're being shown an annuity that has lifetime income and you want to really get an objective, unbiased opinion of where they fit and where they don't fit, give us a call, 630-492-1912, and we'll certainly do that, because so many of these radio shows, doesn't matter if it's here in Chicago or any of the radio shows, it's my belief, just from what I know, 8 out of 10 shows, they already know they're trying to sell you an annuity. They need to cover the cost of the radio show. That's why they're selling these annuities in many instances. So again, we're looking at tax reduction. We're looking at predefined outcome strategies. We're looking at strategies that can deliver positive returns in negative markets. If that is something that appeals to you, we invite you, we welcome you to have a conversation with us. 630-492-1912. 630-492-1912. We're going to talk about Mr. Green and Mrs. Red after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. I am your host, Robert Kuhn, president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Everything that we do on this radio show, in our meetings, at the dinners that we host, if I talk to large groups, is to make sure that you know that you don't have to lose money when the markets go down. All you need to do is have an open mind, and you have to invest in the strategies that are designed to deliver or can deliver positive returns in down markets. That is our motto. That is something that we are very passionate about, and we are going to talk about it a lot. Advisors who don't do it should lose your business. If you're working with an advisor and they're not bringing those strategies to the table, my question to you is why? Why are you working with them? Why is it good enough to have the answer of, the market's down 25%, just sit and wait? Well, that's not a good enough answer. Well, the markets always come back. Well, of course they do. Nobody is debating that. Do you know if the markets are down 20%, the next 25% of your gains are going to just get you back to even? That's just not good enough, in my opinion. If the markets are down 30%, it's even greater, So 630-492-1912, 630-492-1912. We are going to make sure that if your advisor's not sharing with you that those strategies, we are. And we deserve to have that conversation with an individual if they want the most proactive tax strategies, proactive risk management strategies in the market today. Not all advisors are created equal. Unfortunately, 98% of what we all say sounds very similar. But the 2% of action, the 2% of portfolio construction is going to make the greatest difference on your ability to compound your money, and that's our job. So 630-492-1912, 630-492-1912. Okay, Mr. Green and Mrs. Green, really basic strategy. We often talk about sequence of return risk. It's very basic, and it's a strategy, it's not even a strategy, but so much of your success in retirement depends upon what the market is doing when you retire. And that generally is outside of your control. Now, if you own a business, if you, have flexibility in when you retire, I guess we all have flexibility when we retire because we don't have to work. But if you don't have the retirement resources, well, then you're sort of have to still work. But so much of your retirement is a success is, do we have a good market in the beginning or a handful of down markets in the beginning when you start to draw down those assets? These are things that unfortunately are not something that Wall Street wants to market. And this is the most critical aspect, in my opinion, of investing. And it all comes down to losing money. Wall Street doesn't want you to think about it. Wall Street advisors want you to think about it's okay to lose money because you can't time the market. Nobody's talking about timing the market. Since when did defensive strategies become, well, you're timing the market? It's so mind-boggling. Would it surprise you that the bulk of advisors, I believe, have different investments inside of their portfolio than the strategies that they're actively suggesting to their clients? Think about that. Why would they invest differently than what they tell their clients to and how they tell their clients to and how they advise their clients to invest? It's really just scalability. Think about it. Scalability. When you're managing one account, you can invest differently. You can incorporate different risk managed strategies than when you're managing 100 accounts, 500 accounts, 1,000 accounts. And it's unfortunate. We've made the decision that the strategies that we want to bring to the table are strategies that we would consider investing in or invest in personally. Strategies that may be very labor intensive, strategies that may not be super easy for an individual to understand. And that's what we're doing, and that's why we're doing it. Because Everybody makes a decision different. The way people make decisions sometimes surprises me, but that's okay. So we met with a client, a potential client the other day, and they opted not to go with us because they didn't think we had a large enough staff to manage, something. They went with a company that had 12 people. And it's like, okay, so we have 6 or 7. And to me, it's like, who makes a decision based on that? You can have 2 guys and an assistant run $1 billion to $2 billion. I think investment decisions should be made based upon, how are you not going to let me lose money? How are you going to compound my assets at the greatest level? How are you going to reduce my stress when the markets drop 20 to 30% to where I'm not having to stress out about making decisions or selling assets at the wrong time? I think that's how you make investment decisions. But again, that's what makes us different. I want to be friends. I want to know your family. I want you to know my family. I want you to know what's going on in our lives. But at the end of the day, I don't think people need more friends. I think people need advisors that can deliver on the promises that they make, advisors that can not just give more of the same. I have a buddy who is in real estate, and I grew up playing baseball with him, in 3rd grade, 4th grade, 5th grade, and we often talk about just kind of the real estate market. And one of the things that he did is he changed the real estate market here in the western suburbs. Just absolutely changed the real estate market. When I look at real estate agents, I think they're a dime a dozen. And I think 9 out of 10 add absolutely no value. But that one person, he adds significant value, because you know what he would always say is, it's not the market, it's the marketing. And that's so true, especially when it comes to, when it comes to real estate. And, he built a very, very successful business on having the ability to look at things differently, to think outside of the box, to get the most eyes that he can on that real estate property. And he took on the average advisor, and he really has created a niche in the high-end space. And he probably works with everybody. I don't know his, business model, but there is a difference. And quality of advice, quality of marketing, in the real estate space, they're going to drive higher home values. They're going to get that house sold closer. And I get absolutely positively nothing for, giving him this recommendation. But I look at it in the financial advice business and I say, you know what? Most advisors aren't worth their salt. They're all very nice. They all sound very smart. They all are very credentialed. They all have, very nice offices. They all are going to make you feel good. But at the end of the day, what matters the most? And I think what matters the most is, who is the advisor that is able to deliver positive returns when the markets are down? Who is the advisor that is bringing strategies to the table that can greatly reduce your taxable income? Who is the advisor that's not using cookie cutter strategies, basic strategies, that when the market's down and you call them and their response is, don't worry about it, ultimately it's going to come back? And that's not the advisor you want to work with. And 9 out of 10 advisors, is my belief, that that's all they're bringing to the table. They have fancy offices, fancy companies, fancy this, fancy that, but that is all irrelevant. Now, they may be independently wealthy, and that's phenomenal. Yes, you can make a lot of money in the financial advice business, but that doesn't mean that they're crafting strategies for you that can make you either wealthier than what you are today, or if you have, a significant amount of assets and you're not trying to, turn $500,000 or $5 million or $10 million into $20 million or whatever your number is, well, guess what? We can make your lives a lot less stressful in challenging markets when they ultimately come. We can allow you to pay less in taxes if you utilize the tax strategies that are available in the market. And so those are the things that we're doing, 630-492-1912. And we're on a mission. We are just on a mission to get individuals to look at investing differently and use us as a consultant, because my job isn't to talk over your head. My job isn't to sound smarter than you. My job isn't to minimize your thoughts, your concerns. My job is to take complex topics that Wall Street uses, that individuals use, that the high net worth use, and bring those strategies to the table that the average everyday investor can utilize. And you know what that takes? That takes education, and that takes so many meetings, and that takes an understanding that, you know what, you might not grasp it on the first time, but if you're open to trying to learn new strategies that, like, for example, the banknotes, right? 12%, at least, the last couple that we've done, around 12% annual, as long as the markets haven't gone down 30%. I mean, that's a pretty darn good strategy. That's backed by one of the, most of the big banks offer them, whether it's Goldman Sachs, UBS, Morgan Stanley, et cetera, JP Morgan, Bank of America, Citi, BMO. There's a handful of players that live in that market. Why shouldn't we be bringing those strategies to the individual? And those are the things that we're doing that are going to differentiate ourselves versus the competition. And sometimes I don't talk enough about that because, again, 98%, 99% of what we say is going to sound very similar to others. But it's that 1% of actual portfolio construction that's going to make the greatest difference. Everybody wants to think they've got the best. Well, my question to you is, how do you know? How do you know? Because they're in the financial advice space, there is not a clearinghouse that everybody just ultimately reports into, advisors report into, that gives you, their performance. If you ask for performance, do you think the advisor is going to give you their worst account, or do you think the advisor is going to give you your best account? I mean, and again, that is just going to set unrealistic expectations, and I don't think that's being genuine. And so our job is to make sure that we're bringing to the table strategies that can, protect in down markets. 630-492-1912. So Mr. Green and Mrs. Red, man, that was a long rabbit hole I went down. But, and it all started with this sequence of return risk. If the markets are down right out of the gates, it can be a big issue. So $1 million and you're pulling out 5% and you have good, you know what? Well, I'll just go over it and we'll talk more about it, after the break, because I do want to talk about averages after the break. But $1 million, and you had a couple good years in retirement, pulling out 5%, inflation adjusted. You, at age 90, if you started at 66, at age 90, you have $2.5 million left. If you retired and same returns, these are just inverted. So the good happens in the beginning with Mr. Green. With Mrs. Red, you have down 25% right out of the gate, down 14% right out of the gate, down 10% right out of the gate. And your $1 million, you actually ran out of money at age 82. So market averages don't tell the whole story. You know why? In both of these situations, the average annual return was 6%. But it's how those returns fall when you're retired, when you don't have more cash flow coming in, that make the greatest difference. And these are the basic things. I mean, this concept is so simple. You had a lot of clients, a lot of commercial airline pilots, when they raised the age from 62 to 65, around 2007, 2008, that they had to retire, and no fault of their own. They were just forced out. Now that age is now 65, but what happened right out of the gate? You had 2008. So you could have the best laid out plan, the best laid out strategy. The advisor, here's the deal. The advisor could use the exact same strategy that he uses for somebody else, right? But they just happen to retire at the wrong time. And if you retire at the wrong time, and you retire when the markets are down, and you have to take out money from that portfolio, the longevity of that asset is going to come into question. And those are the things that I want to talk about. So we're going to talk about market averages after the break. 630-492-1912. 630-492-1912. Welcome back. You're listening to Destination Retirement. I am your host, Robert Kuhn. I am also the president and founder of Kuhn Capital Partners. We are a fiduciary. We are a registered investment advisory firm, and we really strive to craft portfolios that can deliver positive returns in negative markets for some money. Okay, obviously it's not 100% of your portfolio, but it's something that unfortunately, advisors have gotten away from. Advisors have become asset gatherers because all they do is slap a fee on the account. And then what happens? Their income goes up. Their income goes up and to the right because they're growing their client base, but they're not bringing to the table strategies that can deliver positive returns in down markets. So if you can hear my voice, we can work with you. We do run this show in multiple markets. We try to, we're continuously looking at expanding the footprint because with this thing called technology, we can work with individuals across the country, and we absolutely love that. Yes, we are headquartered here in the Chicago area, just outside of Chicago in Naperville. Don't be defined by the financial advice you get based upon your geography. Don't do it. You have to work with people that are bringing the most cutting-edge, proactive risk management strategies to the table so we can compound your money, so we can make down markets not as painful. I think that's the job of an advisor. 630-492-1912. 630-492-1912. Set that conversation up. Let's talk about it. We would love to share with you our strategies. We welcome you to come into our office always. We think we have a beautiful office, and we would love to welcome you into the office to learn more about what you're doing. If you would like to have a conversation first, we can certainly do that. We can have a Zoom. We can have a just a conference call, whatever works best for you. We often tell individuals it's not our agenda, it's your agenda. And, I think it's really refreshing when people understand that that's how we live. It is not our agenda. It is your agenda. It's what works best for you. That, to me, should go without saying, but unfortunately in a business that like ours, it doesn't. And but that's why we're here. That's why we're busy. That's why we do the radio show. That's why we do the dinners, because our job is to get the message out. We're trying to change the way that individuals look at financial advisors. We're trying to change the way individuals hire financial advisors. Financial advisors, if they're not bringing strategies to the table that can deliver positive returns in down markets like the banknotes that we do, they don't deserve to have the pleasure, to have the right to manage your money. That is how you have to start thinking. And I think most people think that way in almost all areas of their life, but not when it comes to financial advice, because everybody thinks financial advisors are so smart. They're just the smartest this, the smartest that. The reality is we're not landing rockets on Earth, okay? We're not bringing rockets back to Earth. We just happen to have a 25-year head start, 27-year head start on you. And so we just have seen we can look at things differently than you can. And that we want individuals to challenge us. We want individuals to challenge our thinking. We want you to start challenging your advisor's level of thinking. We want you to start challenging advisors' ability to deliver positive returns, strategies that can deliver positive returns in your portfolio. If they're not bringing it to you, we want you to ask why, and we'll help you. We will help educate. And you know what? If you end up leaving them, so be it. It's not a lifelong contract. Moving money from an advisor today is simple. And yes, it's hard sometimes, but it's not as hard as losing money. That's what I like to tell everybody. So 630-492-1912. Because one of the things that you hear on Wall Street in managing risk is diversification. And while we believe in that, we just look at diversification significantly different than you do. Because if you're working with a big bank, if you're working with a big brokerage firm, I promise you that you are going to be very, very diversified in your equities, very, very diversified in your fixed income holdings, but that's it. And if you look at how those assets move when there's stress in the market, they move in, I don't want to say in tandem, but they're not, they're very correlated. which just simply means they move in the same direction to a greater degree than most people think. So people look at diversification based upon the number of investments they own. That's not how you look at diversification. I mean, that is just absolutely positively not how you look at diversification, but that's how the average advisor does, and that's how the investors do. Where's your tax strategies? Where's your energy strategies? Where's your alternative strategies that can zig when the markets zag? We used to use that phrase all the time. I've kind of gotten away from it. I don't know why, because we want to make sure that you do have assets that, go a different direction. You want, when you construct a portfolio, it's really simple. You want to have strategies that don't talk the same language. And when you have strategies, we use 4 different unique strategies. When you can bring those strategies to the table, maybe the markets will never go down. And I guess, maybe the markets will never go down again. I don't know. I mean, it just is what it is. But, you want to make changes to a portfolio when the market's up. You want to keep the gains when the markets are up. You want to incorporate strategies that, and the best thing about the banknotes that we often talk a lot about is we feel like sometimes that we're apologizing for 11% return or 12% return or a 13% return with 30% downside protection. I mean, I have to check myself so often because, my goodness, for your safe money, if you could get that and have it tied to, equity indexes where you had a huge buffer before you didn't get paid a coupon, I mean, my goodness. I mean, to me, that's a strategy that, we have to look at. 630-492-1912. I saw a really interesting statistic this week. And, again, when we talk about statistics, when we talk about returns, when we talk about numbers, I mean, you just have to, don't take them with a grain of salt, but, see what we're trying to say. I mean, could the numbers be off a little bit? Of course. I mean, in a lot of the statistics or stories that we read, we didn't write them. We didn't, but they're from sources that we obviously trust, and they're big. But I saw a really interesting tweet this week. After Bill Gates became friends with Warren Buffett, he began to diversify his portfolio and sold Microsoft shares. The Bill Gates fortune today is $138 billion. If he had not diversified it, it would be worth $1.33 trillion. So even if those numbers are off slightly, I look into that tweet and I say, what are they trying to say there? And what I look at is sometimes, again, when you look at portfolio construction, when you look at asset allocation, sometimes concentration is okay. I mean, sometimes concentration in the right strategy is okay because, it's like a lot of these index funds, right? The index funds, you own the good and the bad. And when you look at what is driving the performance of the market today, a large portion of it is 7 stocks. And I'm sure you've heard the Magnificent Seven. Now it's coming down slightly, but, there was a point this year where I think it represented 30% of the return of the market. And so when we bring it back to you, because everything that we talk about, we want to bring back to an actionable idea for you and how you can incorporate it. If you choose to incorporate it with us, great. If you choose to do it on your own, so be it. But, when we look at, portfolio construction, we look at protected growth, which is where the banknotes fall. Again, 12%, 13%, 11%, whatever that note is paying, as long as the indexes are, it's tracking aren't down 30%. That's generally what we do. That's what I would consider to be a very strong protected growth strategy. And so we have a couple other strategies in that protected growth bucket that we utilize. And again, it may be, I don't know, everybody's different. It could be 20% of a portfolio. It could be 30% of a portfolio. Maybe it's 50% of a portfolio. Everybody's different in that regard. And then we have our growth bucket.
And the growth bucket is just exactly what it sounds like. It's a growth strategy. We don't believe generally in index funds because you can outperform the market. Again, Wall Street doesn't want you to think that. Advisors don't want you to think that. Advisors don't want to talk about that because generally most don't. Because most advisors are crafting portfolios that are what we call closet index funds. They're dressed up as customization, they're dressed up as customized portfolio, but all they do is track the market up and down. And when you add their fee, they're going to guarantee to underperform the market. Well, what we look at in our growth bucket is a strategy and manager. We don't need to get into who the manager is, but it's quantitative and qualitative. It's, very earnings based. It's a strategy that's been around since 1995. And I'm going to quote performance. Now I'm going to preface this by saying past performance isn't indicative of future results. Of course, again, you don't make investment decisions based simply on performance. But I want to get rid of this adage or this thought process that you can't outperform the market. So we use a strategy. It's 50% all cap, which is an all cap strategy, and we couple that with the focused growth strategy. So this is our growth bucket. Okay, so if you put $100,000 in that strategy in 95, it's worth the S&P is. So if you put $100,000 in the S&P in 95, it's worth $2 million today. Now that's assuming you just set it and forget it. Didn't care, didn't touch it. $2 million. Really, really good. If you did the exact same in this strategy, it's at $3 million today. Think about that. So this adage that you can't outperform the market, most don't. Most advisors don't because they're focused on, building an advisory practice that scales so they make personally more money. So they use basic cookie cutter strategies or even worse, index-based strategies where if you want to use a strategy that's going to go with the market, just go to Fidelity, go to Schwab, go to Vanguard, sit with their advisors. That is what you should do. Sit with their advisors, get a basic asset allocated strategy. It's your money. You can do whatever you want with it and ride the market up and ride the market down. You don't need to pay an advisor a fee to do that. So if that's how you want your money managed, which, you know what, some people that they're okay with that, just go to, Schwab, go to Fidelity, go to Vanguard, do it on your own. You don't need to work with an advisor. Go sit with their advisors once a quarter, and you're going to do just as good as the advisor that you're working with. So, but we don't think that's how you should manage money, but again, it is your money. So we've got protected growth, we've got growth, and when you look at focused growth, and this is where I was, or what we call growth plus, and this is where I was going with the concentration of that Bill Gates stat. So if Bill Gates, 130 billion, if he hadn't sold Microsoft, it's, reported that his net worth would be, over $1 trillion, just one individual, over $1 trillion. You have to have aggressive strategies. You have to have what we consider focused growth growth plus strategies. And you should have that. And now people say, oh, no, I can't have it. It's too aggressive. Well, okay, maybe if it's 5% of your money, maybe it's 10% of your money, maybe it's 15% of your money. But why shouldn't you have strategies that can really get after it? And we are in the process of setting up a strategy, a new fund that's going to come in and really target that bucket of your money. Now, you need to have a net worth of $2.1 million, not including your primary residence, or invest $1 million in the fund. And we, strategy is not new. Philosophy, methodology, thought process, not new. The fund is new because we're really going to try to start to, again, we're trying to attack the industry. We're trying to bring strategies to the table for individuals that advisors would use for their own money. So if you have a couple $1 million net worth, not including your primary residence, and you want to learn about what the process is, again, it's going to be in that, what we would consider growth plus bucket. So it may only just be a satellite of your holdings. So if you've got, a few million at Merrill or Morgan or Bank of America, whatever they call themselves now, or one of the big banks or brokerage firms, but you want to carve off, so a pool of money that has, more of a kind of growth mandate, growth mindset that can be concentrated, that can be event driven, that can be, kind of what we call inflection investing. We'd love to share with you, what it is and what it's not. So 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. If you can hear my voice, we can work with you. We are continuously trying to increase the footprint of the radio show. We're very passionate about education. We're very passionate about trying to really change the way individuals receive financial advice. That is our mission. Like I mentioned earlier today, I think my buddy should be, paying me to give, him this recommendation. I haven't given you his name, but, I've always, again, he's disrupted the real estate market. He's the best of the best when it comes to the real estate market. And he just did something that I think is very basic, but that others weren't doing. And he really shined the light on the real estate market in that it's the marketing, not the market. It's the marketing, not the market. And I love that. And I kind of took that here recently into the financial advice world. And I thought, everybody says they're different. Every advisory firm says they're unique, they're different, they're this, they're that. But I want to know why. Why are they different? I mean, do they have a fancier office? Do they have, fancier initials after their, name? Did they go to a fancier college? Why? Why are they different? And the reality is they're not, because 99% of what everybody says, unfortunately, is the same. It's the 1% of portfolio construction that's going to make the greatest differentiation when it comes to compounding your money. And last time I checked, that's what we're here to do, is compound your money and bring strategies that can deliver in negative markets, unless you think the markets are never going to go down. And if that's what you think, then you don't need us, and you don't need an advisor like us that wants to sell education, on strategies that advisors use for their own money, because there's a difference. My belief is the way advisors invest their own money is night and day to what they're advising their clients to do. How they generally make recommendations for the individuals, it's scalability. How can I give advice at a level of scale? Because you know what? They make more money. Doesn't mean you make more money, but they make more money. So that's what we're trying to do. We're trying to, just challenge the conventional wisdom, challenge the conventional thoughts of how advisors, how you judge advisors. So 630-492-1912. 630-492-1912. If you want to talk, we'd love to have a conversation with you. A couple things. So last segment, we were talking about protected growth. We were talking about growth. We were talking about growth plus. And again, that growth plus segment, and I gave you that tweet that the Bill Gates, I don't know if it's his foundation or personally or whatever it is, 123, 124 billion at the time of that tweet. Had he not sold Microsoft, his net worth would be over $1 trillion. And that really just made me sit back and think, because I think when you look at what most investors are missing, it's that bucket of money that can really drive alpha, a real basic word, maybe advisors use it because it makes them sound smart, but that's just return above and beyond what the market is. And again, when, people think you have to be aggressive to deliver consistent positive returns greater than the market, and that's just not the case. You just have to have the right investment strategy. And so my partner and I, we really identified a void in the market, and we thought, well, how can we help, those advisors, or not advisors, but how can we help clients, really solve for that growth plus bucket, that bucket that is really there to drive, performance, that's really solely focused on performance, that yes, it could be volatile, but the returns could be really, really outsized and significantly greater than the market. And, it's just a different way of thinking. It's a different approach. It's a different way of how you're identifying, individual equities to buy in its, inflection investing, in its ways that if you're really right, these strategies, the industry is going to take these names, to really just great heights. And again, it may be 5% of your money. It may be 15% of your money. Who knows? But most people have zero in their portfolio that can really get after it. And I think it's because their portfolio with the other assets are just not allocated correctly. Again, closet index funds, track the market up, track the market down. What if you had 20% or 30% in a banknote strategy that was able to deliver double-digit returns as long as the indexes didn't drop, 30%? Well, if you had that, just that very basic strategy, I bet you're not going to be so concerned about 5%, 10% of a portfolio that may have some volatility. And but again, if we're judged on performance, if the bulk of our compensation is based upon the performance of the fund, well, you better bet that we're going to do everything we can to make sure that that it's going to go up. And I think that's great. Is there a management fee? Yes, but the bulk of the compensation comes from the percentage of profits that we're sharing in. And I think that most individuals would love that. I think most individuals would love that as advisors make money, or as clients make money, advisors make money. And that truly puts us on the same side of the table. So hopefully we're going to launch the fund fourth quarter. We have to be kind of, we can't really dive into what it is, what it's not. But if you are a qualified investor, $2.1 million net worth in addition to your primary residence, or you want to place $1 million in the strategy, let's have a conversation. Let's talk about what it is, what it's not, and see if it's right for you. And if you're with another advisor and or you're managing the money on your own and you want to just use that strategy as a satellite, we're not opposed to that as well. We just would love to have a conversation. So 630-492-1912, 630-492-1912. So we're coming up against it. This week we've got a couple minutes left in the show. I know I went down a bunch of rabbit holes this week, but hopefully you enjoy it. I mean, I see the numbers. I look at the downloads. I just hear many stories of people that have listened to the show for an extended period of time, and they just now are reaching out, and that's great. And my job, I think I look at it as, well, I'd rather shorten that cycle. It's not necessarily self-serving. I'd rather you reach out sooner than later, because we just don't know where the market's going to go. We don't know where the world's going to go. We don't know what's going to happen in the market. We have an election coming up. We have so much stuff going on overseas. I mean, the risk, it is truly off the charts, but that doesn't mean that the market's going to go down. You just have to be protected. You have to be, the way we look at, portfolio construction, and we often talk about it. I haven't done so much, so recently on the radio show, but, protected growth plus, and alternative and tax. I mean, think about alternative and tax. Who doesn't want to reduce your taxable income legally? Now, again, we're not tax advisors. Anytime that you have a strategy that involves tax benefits, it's always best practice to reach out to your tax advisor. That's just best practice. I mean, these are very basic, but it's still best practice to do. And, those strategies, again, last year, had you invested $100,000, $100,000. For every $100,000 you invested, you reduced your taxable income by almost $90,000. Active income, passive income. So, sold a business, sold property, high wage earner, want to do Roth conversions. You're taking out RMDs, and you want to minimize, the tax hit. We have a strategy. Just takes you learning about the pros and cons of that and making sure that it makes sense for you. 630-492-1912, 630-492-1912. So it's I think it's going to be an interesting, end of the year. My crystal ball isn't any better than your crystal ball, or any advisor's crystal ball. Nobody knows. Absolutely nobody knows. We read a story a couple of weeks back from J.P. Morgan, and take it for what it's worth, but they thought the next 10 years the performance was going to be below average, below trend. And that may be. And that wouldn't be the worst thing for us if we're looking at it selfishly. Advisors like us that are bringing four distinctly, uniquely different strategies to the table. Well, individuals can